So a couple of things related to your paper. I did get a hold, for the team that's doing the gig economy, are y'all in here? Gig economy, all right, so he said you can contact him. So you want to get the insurance industry's perspective, and he worked for Buckle, so his email is bondwickwire@Yahoo, and there's his phone number. I don't know if you can get that. So he's willing to talk to you. He probably has he's a smart guy, so he had some insight. He didn't work there a long time, but he will give you some insight. And then the cat bond people, we were sent this article talking about the insurance argument for why you would do catastrophe bonds. They sent us this PowerPoint, which looks really good. Why cat bonds? Again, the investor standpoint, so some really good stuff there. And then they sent us this one other one. I don't know why it's doing that, but one other one. So I'll send those to you. Boy, that looks really strange. I don't know what it's doing. Well, completely out. So anyway, I'll forward those to you. But who's on that team? So Diana, right? And Beverly. And Daniel. And there was one other, right? Oh, Alan. That's right. I don't know which Alan you are. Alan. Yeah, if you want to type it in there. So we may spend some time next Wednesday night on the paper. I'll let you know. Gives you some, I forget when the due date is, but it gives you some extra time. We're doing okay on the class time. Right, thanks. I'll probably have this group speak to the class in a future class because it was really good what they did. Their knowledge base. I mean, they had me really excited in the presentation. Just really amazing stuff. All right, let's work one more of these Schedule P problems to get a little more practice. And give you one more video where you have these in here. So we'll give you two. I believe there's one out there on Canvas as well. I'm using Allstate. I'm having a tough time doing Allstate today because I went to the website and they're not posting their annual reports. So I'm having to go back a few years. So when we do accounting, I may have to try to find another company to do. So there's 4 questions. The first one's, you just have to learn the formula. It's fairly straightforward, but it's the risk-based capital formula. That's where you're going to use this here. Anybody remember the formula? I mean, you could just take the 12 billion divided by the 3 billion, but there's only one adjustment you have to make. Anybody remember? No takers on that? We did it last class. What is this authorized control level? It's 50% of risk-based capital. So get the ratio. What do you have to do with this number? Multiply it by 2, all right? So RBC is going to equal the total adjusted capital divided by authorized control level, RBC, times 2. And the authorized control level it's not a number that means anything. They don't use it in the law. It's just 50% of risk-based capital. You need that number of times 2 to do the ratio. So in this case, you have, and here you can definitely round 12,244,000,000. You can even round that much if you like, divided by 2,966 times 2. You'll probably get something in the 400, 500, 600 range. I can't do that in my head. Well, 244. Someone check my math here. Do it as a percent. Oh wow, I get a really low number. I get 206%. Anybody get that? Wow, that's pretty low. Wow. You hit 100 and go below, that's when the regulators step in and start running your business and telling you what to do. So 100 is pretty scary number. It's amazing they're that close to 100. I mean, 2 times in ratio is not a very good number for a firm like Allstate. You can see, well, look at the numbers here. Look at the previous year. The the RBC went up, but their adjusted capital dropped. So 2022, what happened? That's when we had interest rates rise, bond markets crashing. So it was a pretty bad year for them, inflation up. So that was just a bad year. So that 206 is a really bad ratio. All right, here, the loss development, this one's really, really simple. All loss development means 1 year is you take the current, you take whatever you're looking at minus the previous, the 2 years, you take the current year minus 2 years ago. Whatever you get, a positive, negative number, that's what you show. So one column minus 1 year ago, one column minus 2 years ago. All right. So here we're looking for the 1 year and 2 year loss development that reported for calendar year 2022. That's that last column. For 2017, remember accident year, you go across. So 2017, we're looking at these numbers right here. 17,778, 17,738, and 17,603. Those are the numbers we're looking at. And it really is just a subtraction problem. Essentially what we're asking is that they have to add to the reserves or could they reduce the reserves? We're really we're somewhat grading them on the quality of the reserves. So the 1 year development, again, this is that word that Warren Buffett didn't like. He says reserves don't develop over time. We just become better at forecasting. So you got 17,778, 283 minus 17,738, 400 here. I wouldn't round. If you get a positive number, so it is a positive number. Positive numbers are bad because that means they had to add to the reserves. Negative numbers are good because it means they over reserved. Although really zero is what you really like. In the 2 year development, take the same numbers, 17,778, 283, and you go back 2 years, 17,603, 276. Both of them are positive numbers, so not necessarily great. You can see they increased quite a bit last year, but not quite enough. Question that one's pretty straightforward. The calculation is fine. I just want you to also understand what does the number mean. You don't have to write an essay what the number means. I just need the numbers. The positive numbers mean they had to add more to the reserves. Negative numbers mean they got reduced reserves. Yeah, just all I need is the numbers. Yeah, I write out this as well, just in case there's a math error. I won't count off anything if it's just a pure math error. But yeah, show me where you got the numbers from. Because if you're at 39,983, it's like, well, I don't know how they got that, but if I see you just had a transposition problem, it won't be a problem. But I do want you to know what it means, but you don't have to write any essay there. Right, here's the reserve. Remember on the reserve, what we're doing is looking at how much they ultimately think they're going to pay versus what they have paid to date. All right. So we're looking for 2017 accident year for the business as of 2020. So what reserve would they have set up in 2020? So 2017, 2020, there's that 17,603, 276. 17,603. So incurred expected in 2020 was 17,603,276. Paid in through, not in, but through 2020. So again, go to schedule part 3. So part 2 shows you the incurred. That's how much they ultimately expect to pay out. So at that time it was 17,603,276. And you go look for the same number on the paid, and that's 16,641,062. I got that right. 16,641,062. So the reserve is going to be 17,603,276 minus 16,641,062. Someone can check my work. I get 962,214. Sound right? 962,214. All right. Just to give you some exposure to what a reserve is. Pretty straightforward number, actually, not that complex. And don't overthink it, because I realize this number right here is going to adjust the next few years. But I'm saying if you're sitting at 2020 and that's what you believe, then set up the reserve for 2020. That's the reserve they would have set up. They don't know that they're going to make that adjustment the next couple of years. The last one's probably the trickiest, but certainly doable. And I kept you on year 2017. I've discovered that it's easier to keep using the same year over and over again from your data collection from these massive numbers. You notice I rounded on question 1, but didn't round on questions 2, 3, and 4. So what we're looking for 2017 is what we ultimately expect versus what we knew. So we're comparing 2017, the 2022 number, to the 2017 number, I think. So incurred expected 2022, incurred expected 2017. So 2022 is at 17,778,283 that we've had before, using previous questions. 17,778,283. And as of 2017, it was 17, I'll never remember this number, 17,943 something 553. So they actually, if you think about 2017, they start off with too much the first year. They kept that pretty constant the next year. Then they started dropping it by 100, dropped it a couple of hundred. Then they raise it some, and then they raise it some. So they start off way too high and they end up much lower. So as of 2017, you look at that difference, it's going to be 17,778,283 minus 17,943,553. Someone check me here. Difference is 165,270. Net income was All right, so here's what you think about it. We're talking about an expense here. In 2017, they expensed 17,900,000,000, but they should have, if we knew what we knew today, they should have only expensed 17,778,000,000. So was net income overstated or understated? Did they expense too little, or did they expense too much? Too much. Understated, right? Understated by 165,270. Now, if you say overstated, you don't get zero credit. If you get the 165,270, you'll get some credit, but you will lose some points. But you do have to stop and think. But if you get a positive number, then they would have understated net income. If you get a negative number, they would have overstated it, because we're not talking about revenue here. We're talking about an expense, right? The exam's still about not quite a month away, 3 weeks away. So you'll have to go back the week before the exam and practice these some more. There's 3 math questions on the exam, and there's only 1 essay. What's the essay question? I remember someone was asking about that. Who was it? Was asking me. I remember credit scores. So I have a credit score question. So you could already start writing that one, get it done. I'll get you the rubric for it, but yeah, you could definitely start writing that one. The other questions, like math questions, like killer math question, and then we have one last one to do here. All right. Okay, missing anybody? Oh, all right, I'm in there. All right, going back to the class notes, we're up to the accounting section. If you're going into an interview with an insurance company as an actuary or financial position, I would spend some time figuring out some of the critical parts of the insurance accounting. It is very different than bank accounting, than any other accounting. You're used to the accounting that you're taught, the current assets, non-current assets, property, plant, and equipment, um, cost of goods sold, those kind of things. Insurance companies don't have those. It's a very, very different type of business. One thing to keep in mind for banking and insurance is these are spread businesses. So spread business is you're making something on your assets, you're paying something on your liabilities, and you're making a spread. It's a very different type of business. Banks have what's called the net interest margin, which is what they make on their loans minus what they pay on their deposits. That's the net interest margins. Insurance companies, it's very similar. The big difference between banks and insurance companies, banks are really unique, probably of any business out there, where they have customers on both sides of their balance sheet. So in the assets, they have auto loans, credit card loans, mortgages. So they're loaning money to their customers. And on the liability side, they have certificates of deposits, savings accounts, checking accounts. So it's a pretty unique business. Life insurers, their customers are all on the liability side. It's the reserves. And then they buy assets to fund that business. So let's look at some of the key things you want to know. First, you want to know is that there are 2 books, maybe more if you count the tax reporting, but really 2 books. GAAP and STAT, as we call it. GAAP is the accounting you're taught undergraduate, and your accounting classes are really graduate as well. It follows most of the rules you learn undergraduate, but it does have some special things for insurance companies. And then statutory is what the states require. GAAP is following FASB, Financial Accounting Standard Board. It tries to be more realistic, tries to really tell the firm, show us what you really, really believe. Its focus is on earnings because it's focused on the stockholders. So GAAP is more focused on earnings. It is a consistent look, although they have started consolidating the statutory side. They don't really do it that well, especially the life insurance side is not consolidated that well. But the focus is on earnings. The focus is on the income statement. You might say the cash flow statement, but I don't know anybody that uses bank and insurance company cash flow statements for analysis. It's just not real useful information. So it really is an income statement focus. Statutory is mandated not by FASB, but by state law. You can't fully understand an insurer just looking at the GAAP financials. It does some things that really distort the world. So you really need to learn statutory. Now, when I started at USAA, they were only doing statutory. And about a year in, well, when I started at USAA, we just got personal computers for the first time ever. So everything was manual. You think about, I'll show you the stats statement. It's massive. You think about people typing all of that. It's pretty amazing. I mean, I just showed you the exhibits, right? Someone's typing all this stuff. So when I got there, this was all we started doing it by computer and going into a system that was pretty amazing that we didn't have to type this again. But there's a lot of detail. I'll show you. I had to show you Allstate 2 years ago because they're not loading their statements anymore. So you got to learn statutory. So when I started USA, we're only doing statutory. We started doing GAAP, and the way we did GAAP is we started with statutory and made adjustments. We called them the GAAP adjustments. So since we did statutory and all the detail, and then we summarized the GAAP, and then Bob Davis became CEO of USA, and guess what? He didn't care about statutory. He only wanted GAAP. So then we had to switch our gears completely. I like statutory accounting. There's a lot of really, really good information. The Bloomberg machines down in the FSC, they actually have statutory information for insurance companies. I'll show you some of the data you can get out of that. I think I showed you some earlier in the class. If you're going to learn, the best is to learn statutory and then learn the GAAP adjustments. So how does GAAP differ from statutory? Because the statutory is really the starting point. Statutory accounting is very conservative. It tends to give you lower net income, lower assets, higher liabilities, lower net worth. The focus here is the balance sheet because the goal here is that the firm doesn't go insolvent. So it's really the regulators are looking at the firm. We just looked at risk-based capital. That's a statutory number. That's not a GAAP number. That's what the regulators look at. It tends to be unconsolidated. You don't mix, while they will consolidate the P&C side, they won't consolidate the P&C life together. And I don't think they've ever talked about doing that. It would be really awkward to do it because they look so ridiculously different. They separate the revenues into two sources, premiums and investment income. Now, if you look at Allstate and Yahoo Finance, it does look a little bit different than other companies might look. They do break up the premiums and investment income, but for statutory and GAAP, well, statutory accounting, we separate the underwriting from the investment income. So on statutory accounting, investment income would be much further down. So remember what you did for the pricing exercise. You did premiums, claims, LAE, expenses, you got underwriting, then you did your investment income. The GAAP is putting all the revenue together. You don't really do that in statutory or really in any kind of investment company. So this right here is not normal what you would see with an insurance company. So you always separate the premiums from the investment. The investment income comes after your underwriting gain and loss. Your costs of revenues are your claims that you've paid plus the change in those reserves. So the change in reserves, you have loss reserves, loss adjustment reserves, and unearned premium reserves. We'll have to talk a little bit about I'll talk about this more when we look at a financial statement. The loss reserves are the massive ones. That's the one we were just calculating when we looked at incurred minus how much you paid the day. That gives you your incurred losses for that year. Remember, this incurred loss that you show is really the combination of all these accident years. So any given year's losses is going to be all those accident years. It includes all those changes in loss development where you're adding to reserves, reducing reserves. It's just a mix of all those years combined. The actuaries think about it across the line. How is this particular line, this particular product that was sold in 2015, how's it doing? The accountants look at it here, which there's a lot of distortions from the accounting standpoint. Their expenses are pretty normal, even on the statutory side. They have what they call general expenses and tax-related expenses. They do separate the loss adjustment expenses up higher. The taxes, I'm talking about premium taxes, not federal taxes. So premium taxes, that's how states tax insurance companies. Now we had a treasurer of the state of Texas, Rylander. Y'all remember her? That's probably way before your time. Hopefully you're not related to her because I'm going to say something bad about her. But she went after USAA during her tenure. She was livid with USAA because USAA doesn't pay franchise tax. She's like, that's not fair. USAA should pay franchise tax. Well, USAA is like, we don't pay franchise tax because we pay premium tax. And the state law says insurance companies don't pay franchise tax. But she was going to take us to court. USAA won the whole thing. USAA was never worried. It's like the law is real clear. Insurance companies pay premium taxes. I don't know what made her so upset. She was really, really going after us. USAA is not paying its fair share of taxes. That's how insurance companies pay their taxes. They pay a percentage of premium taxes. There is something called the retaliatory tax, and this is pretty hilarious. So one state might charge, like Florida, it might charge Florida companies 1% premium tax, but non-Florida companies 3% tax. Well, Texas doesn't like that, so they retaliate and charge Florida companies a 3% tax, and it goes all over the place. And what we discovered at USAA, we went to the Texas legislature, and we told them how they could change their different tax rates so they actually collect more premium, and we would actually pay less premium in Florida, and they bought it and went with it. So there's some games you can play with this between different states. That's pretty hilarious. But that's what's called retaliatory tax, where states try to help their companies and harm other companies, but they want to get as much tax as possible. And they end up playing against each other, so they all end up losing at the end. It's quite complicated, but there are ways to do it. Throw on top of that, there's what we call premium tax credits, where if you invest in certain things in states, you get credits for premium tax. We did billions of dollars of that when I was at USAA. So you can essentially eliminate your tax by investing in certain type of businesses in Florida or Texas. So this is a huge deal because it's hundreds of millions of dollars, and it gets quite complicated. But all right, what else do you see in insurance companies? One thing you see, I think, is actually in Yahoo Finance. Here it is right here. It's called policy acquisition expense. You will not see that in any company other than an insurance company. It's life and property and casualty. It's the weirdest thing. When I first heard it, I thought, what in the world are you talking about? Really bizarre. And it's not immaterial, right? It's $8 billion. Their pre-tax income was $5 billion. So without it, they would have lost, well, they would have made more money. But actually, they probably would have lost money without it because I'll explain what it is. So what policy acquisition costs are, it's only for GAAP, it's not for statutory. What they say, insurance companies incur a lot of money to get business on the books. They got to do underwriting, they got to do blood tests on the life insurance side, they got to check driving records. And so what the states have said is it's so expensive, and this is really GAAP, it's so expensive to add a product. We're going to take all those costs to add a product, and we're going to let you capitalize it as an asset and expense it out over the life of the product. Ridiculous. I think you could almost argue that for other industries, but for some reason they get around being able to do that. It is a materially big number. It tends to be a bigger deal for life insurance because of all the underwriting you have to do, blood tests and medical expenses, but it's a big number for property and casualty as well. It gets really complicated because there's something called DPAC unlocking. It's a huge issue for life insurance companies. Do y'all remember LIFO unlocking, or what do they call it? Oh, I haven't had inventory accounting for so long. Do y'all remember in accounting and inventories, there's come a point where you may have to write off some of that LIFO accounting for cost of goods sold and inventories. That ring a bell at all? Ridiculously crazy accounting. This is even more complicated. I used to understand it at one point. An actuary came and explained it to me. I understood it extremely well. And then he left the office, and 15 minutes later, I couldn't have explained it. It's just so convoluted. So there is stuff like that in insurance companies. This is really where you earn your keep. If you start on the corporate side, this is the kind of stuff you want to learn, because this is what distinguishes your company from other industries. So you learn this crazy stuff. So deferred policy acquisition costs. This isn't something the accountants do. This is something the actuaries do. It's a very complex mathematical calculation. So you capitalize an expense, you're going to spread it out over time, but it's possible something happens that you can't spread it over time. You have to take an immediate hit, and that's called DPAC unlocking. As accounting uses the matching principle, so that's why they're doing this. They want to match up your expenses to when you earn the revenues. Since you incurred all these expenses today and the revenues can be earned over several years, they let you spread it out over those years. Which means you're going to see an expense that doesn't exist anywhere else on anyone else's books. And then on the balance sheet, you should see the deferred policy acquisition asset. So there's the asset. So anyway, that's this strange accounting. Premiums for insurance companies, they have something called premiums earned. So how do you get premiums earned? When the policy's signed, you don't earn the premium, but you have written the premiums. So make this real clear. Written premium, this is really bizarre. The written premium is all of the premium when you write the policy. So let's say you have, let me give you an example. I think I have an example down here, but let me show you and then we'll do the example again. So let's say you buy auto insurance in December for $1,200 premium, $100 a month, 12 months. As of December, you've written $1,200 in premiums. That's called your written premium. As of December, you've earned $100. That's your earned. Now, written premium, why is that an important number? Well, do you remember on the pricing problem, we're doing the surplus ratio. Which equals premiums divided by surplus. Remember that 3-to-1 thing that we did? Which premium do they use for that ratio? They use the written premium. So for capital requirements, these are written. Why? Because that is when you accept the full risk. You haven't earned a premium, but if the person has an accident tomorrow, you got to pay them. So you're on the hook for this. That entire premium is at risk. So we use written premium when we're calculating your surplus ratios. Earned premium, this is what goes to the income statement for net income. And you think of anything like that in another industry, I can't. And this is P&C only. It doesn't apply to the life insurance side. So there's some really unique numbers. You might think big deal, but I can tell you, USAA, you start talking premiums, they're going to say written or earned. They're going to make it really clear which premium, even though they're really pretty similar numbers. So when a policy becomes effective, the policy is written. That's the day you signed it. That's when you have coverage. When that happens, the premium is 100% written. Over time, the risk coverage goes off, and that's how you earn the premium over time. So I'll give you a math example down here, kind of similar to what we did. But what the earned premium is going to be is, well, let's walk through the math. So a policy is sold on March 1st to be effective May 1st. It's a $10 a month premium. On March 31st, there's no written premiums. There's no liability. Why? Because it's not effective until May 1st. That's when it becomes written, on May 1st. As of June 30th, you've got May and June, 2 months out of the 12. The written premium's the full $120, because that's when you did the policy in May. Your unearned premium is $100. That's 10 months of that $10 you haven't earned. Your earned premium is going to be your written premiums minus the change in unearned premium. You wrote 120. Your unearned went from 0 to 100, so you earned 20. The unearned premium reserve, that's that huge reserve on the balance sheet. Reflects the fact that you have written and you have earned premiums. This is a massive liability on an insurance company's books. Essentially what it's saying is the difference between what we've written and we accepted the risk versus what we earned, we're setting that up as a liability. You can look through the other months, but that's the way the math works. We already talked about the premium surplus ratio. It's one of the two ratios. We did risk-based capital and the premium to surplus ratio. So it's just one way of measuring risk. They also have a premium receivable as an asset. You might wonder why in the world did they have this premium? Because if you don't pay your premium, they can't come after you with collection agency. You just lose your policy. But the reason they do that is because they set up a liability for that whole premium, so they get an asset for that premium. It's strange accounting. They essentially like ballooning the balance sheet on the statutory side. They force you to set up liabilities that aren't really liabilities, but then you get to set up assets that aren't really assets, and they offset each other. It's just like strange accounting. I saw a lot of that on the life insurance side as well. I was like, why are we doing this? But it's just the way they've set things up. Most of these companies have holding companies. If I can get you in the all statements, I'll show you how complex these entities are. I think we talked some about this earlier. They usually use the holding company as a non-insurance company to do all their borrowing and issue stock, so they don't have a regulated entity doing that. So it's the way, and even USA has a holding company, even though the parent company is a property and casualty. So SNL is a great database. If you work for an insurance company, let's see if this still works. It's not the Saturday Night Live version. It's owned by S&P. It's really great database. We use it all the time. In fact, anytime we had interns, this was their project, because I've given this database and we just ask questions about the whole industry. So it has every single insurance company in the United States. And I'll show you that annual report can be thousands of pages long. It has every single piece of information from the annual report, and you can pull it very quickly in. It's really cool. I did a presentation at USA years ago. I mean, this is not new technology, where I compared USA's asset allocation to every one of our competitors. I was getting all the data from here. I was pulling in hundreds of thousands of securities, literally classifying them. But you can do it with this pretty quickly. It's a pretty efficient database. Ask around. I know at USAA, they had it, but you had to know to call Brian to get it, because he's the only one who knew the password. So you have to figure out. Fortunately, he was a good friend of mine, so I was able to get access to it. But USA had, several licenses that you could use it. So if you're working for an insurance company, I would real quickly ask if they have the SNL database and see if you can get access to it, because it's really good information. I don't know how much it costs. I'd be scared to know, but big insurance companies should all have that database. All right, let's talk a little bit more about risk-based capital. I can't remember if I put the actual law out there for you. So the purpose of risk-based capital is to make sure you have enough net worth. We were looking at Allstate. They have assets of 99 billion. And their book value is 18 billion. So it's like 90 to 20. That's pretty typical for a P&C company. For a life insurance company, it's more like 100 to 10. So they're more capitalized. Why? Because they have hurricanes and earthquakes and those kind of things to insure. Today, it's 15 billion versus 110 billion. So about 100 to 20 or something along those lines. Well, if they're asking, the question is, well, here's their actual equity, 21 billion. Is 21 billion enough net worth for Allstate to cover their risk? Now, this is their GAAP net worth. Their statutory net worth would be smaller than that. So surplus is really net worth. Do they have enough net worth, enough cushion to protect the company from going insolvent and not able to pay its claims in the future? It's more sophisticated than that premium surplus ratio. I gave you the premium surplus ratio just to keep the exam question simple because it's already getting pretty complex. Risk-based capital takes into consideration your mix of business, unlike the premium surplus ratio, just assumes all businesses are the same. There's 4 categories: C1, C2, C3, and C4. C1 is asset risk. So it charges 20% if you hold stocks, because stocks are pretty risky. If you hold treasuries, it doesn't charge you anything. If you hold investment grade bonds, it charges a little bit. You hold junk bonds, it holds you that 15%. If you have a subsidiary, it subtracts out 100% because it assumes the subsidiary needs its net worth for its business, so you can't double count it. That's called pyramiding. They also charge you for having too much in one name, too much concentration in one name. So that's C1 risk. C2 risk is real important for property and casualty companies. It's your insurance risk. What they're looking at is what's the chance you have auto claims that are a lot larger than you expected, or homeowners claims. That's where the probable maximum loss will come in. Y'all notice that Kirby didn't define maximum probable loss. I was wishing he would. I almost asked him, but he talked about probable maximum loss. I still don't know the difference in the two, but probable maximum loss is the number you really use in places like this. So that should be the biggest risk for a P&C company. For a life insurance company, it's going to be C1 and C3. For insurance, life property casualty insurance, it's going to be C2 risk. C3 risk really is for life insurance companies only, and that's that disintermediation risk when interest rates rise and fall. That's a huge deal for them. And then C4 is just a catch-all. All these other risks. And essentially what they do here with C4 is kind of ridiculous, but they say, what happens if the industry has a problem and an insurance company goes under and you also have to bail them out? How much do you need to set aside for that? So it's essentially a risk that someone else goes insolvent, you got to bail them out. So those are called guaranteed association charges, because the state does have FDIC type of insurance for insurance companies. But unlike the FDIC, y'all know with banking, you don't really worry about the bank going under because they're going to bail you out. But on the FDIC side, they collect money in advance. So they charge banks every year to build up a reserve. The guarantee associations don't. They don't collect money until someone goes insolvent. So if you have insurance with State Farm and they owe you $10,000 and they go insolvent, you'll get your money, but it may be a long time because they got to collect all this money from the insurance companies. One thing that's interesting about this, I thought was kind of strange. It sounds like the insurance industry is bailing you out, because if a company goes under, they charge the insurance company. But guess what the state does? If you pay guarantee association fees, it offsets your premium taxes, so you pay less premium tax. So if you really think about it, it's the taxpayer of Texas that's really bailing them out, because they're either going to get guarantee associations or premium taxes, but not both. The way these risks are brought together is, some of you in my risk management class will remember this formula, right? Does that look familiar? Stephanie, or pick on anybody. Daniel, you're in there. So So you got the standard deviation of A squared plus standard deviation of B squared plus 2 times standard deviation A, standard deviation B, correlation AB. How many of y'all know that formula? That's one of those key formulas in finance that everybody should know. If you're in my risk class, you better know it for the final because you're going to be doing it like 20 times. So really, really important formula. What this means is if correlation is 1, you just add them together. It's just a 2 risk. If correlation is 0, you square the first one, you square the second one, and you take the square root of those. So essentially what the state is saying is C1 risk and C3 risk are perfectly correlated together. So when you have a C1 risk blowing up, C3 is blowing up as well. But that C2 risk is uncorrelated to C1 and C3 risk. And so it's assumed the correlation of 0. And then C4 risk is perfectly correlated to the other 3. So correlation of 1. So essentially what they're saying is C2 risk is the one that's the odd man out. It's not correlated to anything else. And so we're going to reduce that overall risk because it's not correlated with the others. It's a simplified way of combining risk, because if you just add them all together, you're probably overstating it because it's unlikely all 4 things are going to happen at the exact same time. It's an interesting formula, a simplified formula. I do recommend you think about this because it is a really simple way to combine risk. All right, let's look a little bit at Allstate. This is unfortunately a few years old because I could not get, this is 2021. I tried to get 2020. I looked at 2024 and it wasn't out there. So I looked at 2023 and I clicked on it and it gave me an error message. So I looked at 2022, clicked on it, gave me an error message. 2021 is the only one I can get to work. It's the same form of same one, but it's just a little old. I'd love to show you 2022 because that was such a horrible year. So it starts with the balance sheet. If I click on Yahoo Finance, what's the first statement they show me? The income statement. In insurance, you start with the balance sheet. It's 2 pages, assets and liabilities. GAAP financial, what's the first asset in your GAAP balance sheet? You remember? Or do you start with at top? Balance. Cash, whatever short term, cash. Not here. What's the first thing here? It's bonds. Cash is way down here. I don't even know where it is, somewhere down here. Here's cash. So they don't start with the most liquid, they start with the largest item. Bonds is the biggest asset they have. They have $33 billion in bonds. We'll talk about this when we talk on the investment side. Life insurance companies are like 98, 99% bonds. Property casualty companies are probably 70%, 80% bonds. 33 billion, their total investments is 53 billion. So 33 billion out of their 53 billion is bonds, right? Their common stock is 6 billion, but that's a little bit exaggerated because that includes their subsidiaries. Allstate owns a lot of subsidiaries. This is consolidated. So it's all the P&C companies are consolidated, but it includes their life insurance company and some other things. So they don't have as much in stocks as this looks like. Another number you'll notice is cash is a kind of a big number, but Allstate has a very large other invested assets. They do a lot of derivatives, private equity, some real estate. That's a pretty big number, but you can get most of their investments between bonds, stocks, that's 40 billion, cash, 42 billion, 52 billion. Of those 4 items, that's almost all of their investments. Other companies would be similar, except they would not have this large other invested assets. USAA is the oddball because USAA has a massive real estate portfolio, which is really unusual for property and casualty companies. You will notice some real estate. It's really small, but their home office, where would you do that in GAAP? In GAAP, you call that property, plant, and equipment. For Allstate, it's an investment. And again, it's really bizarre accounting because Allstate pays itself rent for the building it occupies. So talk about bizarre accounting. They actually show rental income from themselves on the building they own that they occupy. And that rental income goes as investment income. It's really bizarre accounting, but that's their building. They do have some investment properties, but probably some of these are mortgages that they did in their bond portfolio that defaulted, and they got the property, they got the keys, so it's real estate they picked up. Insurance company, other than USAA, property and casualty insurance companies don't do a lot of real estate. So there's their investments, 53 billion. Their total assets is 63 billion. So that's, you wouldn't expect that with Walmart, right? With Walmart, you expect property, plant, equipment, receivables, inventory. Insurance companies, the biggest asset are their investments, because that's what the business is. It's a spread business. Most of the other assets are these premium assets we somewhat talked about, which are more kind of accounting smoke and mirrors than they are really assets. So the bulk of their assets are the investments. Then you get to the liability side. What's going to be the biggest liability? It's going to be those loss reserves. We just did that, right? We took incurred minus paid, 17 billion. Their total liabilities is 42 billion. 17 billion of that is losses. There's their LAE reserves. And here, look at their unearned premium reserves. So that's 30 billion, 35 billion of their $42 billion are reserves. How important are the actuaries? They're the majority of the reserves. That's what they do. And look at that unearned premium reserve. Remember, this is a number they set up mainly because of that written premium, and it's a strange accounting. It's almost not a non-existent liability, but they set it up. It's massive. It's, you know, big percentage of their liabilities. They have normal accounts payables like other companies, and then they have something that's a little bizarre. This number right here, it's not large, but you will not find this on anyone else's balance sheet other than life insurance and property and casualty. It's called remittances and items not allocated. Why is this important? But this is the nature of insurance. So USAA, when I was there, they had a machine that processed about 40,000 checks an hour, really fast. Hundreds of $1,000s coming in, maybe even millions. They don't have time to look at every check and see if that's a valid customer. They just got to move fast. The machine is, and it's pretty amazing. I don't know if you've seen some of the machines. Y'all don't pay by check anymore, so it's probably not like that anymore. But it opens the envelope, looks at the check, looks at the pay stub, at the two match, it endorses it, sends it to the bank. I mean, it's just rapid. But what if someone says, you know, I'm a really bad driver and I can't get insurance. I'll just mail the premium to USAA. If they cash it, then I've got insurance, right? Because they accepted my risk. I could cash my check. Well, that's what this line is for. The state says you can cash their check, you can take their money, but you can't find them as a policyholder. You got to put it in this account. And if you determine they're not one of your risks, you can send the money back to them. You have no risk. That allows insurance companies to process payments really quickly. Think if that wasn't the case, what you could do. You've got a hurricane out in the coast, so you quickly mail a check to USA for homeowners insurance. And if they cash it, they got to insure you. You imagine the kind of risk that we create for insurance companies. So that's a unique line. It's not a large line, but a unique line. There's another line you would expect to be really large. Look at line 8. That's their debt. How much is their debt? Can y'all see that number? Does that mean Allstate doesn't have debt? Well, let's look at their financial. Sure enough, they've got $8 billion in debt. Why does Allstate have $8 billion in debt, but they show zero here? What did I just talk about? Where is the debt? Remember the holding company? All their debt is at the holding company. It's not in the insurance company. So borrowed money, they have it on their books. I'm not saying every insurance company should be zero, but for USA, for Allstate, I don't know about State Farm, it's a zero number. So very unusual. all that stuff we did with Schedule P gives you some confidence of how good these numbers are. That 1 year and 2 year development, if that's constantly a positive number, and that maybe give you some concern that this number is understated. If it's constantly a negative number, you could say that number is conservative. So there's a lot of analysis you can do. Then you get down to net worth. It's just a massive number of lines, a lot of detail. They do have treasury stock and just like other companies. And again, they don't call it net worth. They call it surplus. And they don't even say surplus to the stockholders. They say it's surplus for the policyholders. It's how much money does Allstate have to cover in case they make mistakes so they can cover their policyholders. So there's the balance sheet. Bottom line, heavy on vested assets. The asset side, especially bonds, stocks, cash, and then heavy on reserves on the liability side, mainly set up by the actuaries. Then you get to the income statement. And just like we talked about the income statement, look at where investment income is. You're not going to see too many income statements where a revenue line is that far down. That's because we always keep the underwriting separate from the investment side. The life insurance side is similar to this as well. You always separate those two. You can see their premiums, 37 billion. Here's their underwriting costs, their losses, UAE, underwriting expenses. So there's their underwriting gain. You notice they had a bad year in 2021. They went from 4 billion to 641. But did they have a bad year? The accountants say they have a bad year, but you could go through their Schedule P, and it might have been they under reserved 2 years ago, and that's flowing through today. You don't know if that's a bad year this year or a previous year that was bad. They're just figuring out this year. So kind of tough. Here's their investment income. They did well on the investment income side. So they had investment gains of 4 billion. Their investment almost doubled. And then their net income is about the same because the investment income brought them back in. Here's their federal income tax, and here's their net income. You look at those loss development numbers, you're looking at, sometimes you can see differences of 500 million, $800 million. It gets material to the net income. The actuaries can really drive this. There is a case, actuaries tend to be very high integrity people, but there is a case you could make that if management's not making their numbers, the actuaries could tweak the reserves enough to get whatever number you want, because there's pretty wide range of what's acceptable. I doubt any company does that, or if they do, they don't do it in email. They do it, talking one-on-ones and making sure nothing's recorded. But there is enough fluff in there that they could essentially almost hit any number they wanted to. And here's their net worth statement. The only strange thing in here, I can see it. It's called surplus notes, but I don't see it in here. Yeah, I don't see their surplus notes. So there is, from a GAAP, a statutory standpoint, they have something called surplus notes, which is really borrowed money that the regulators allow them to count as net worth. It's pretty unusual. I don't know why it's not showing up in here, but it's in there somewhere. So you will see that not many companies use that, but the regulators say some companies, new companies, have a lot of trouble getting their net worth positive. So the states have said you can borrow money, we'll count it as equity, but you can't pay the debt back without our approval. That's what a surplus note is. You can look up surplus notes. They are somewhat out there. So surplus notes are debt issued by insurance companies to raise capital, net worth. They go into the capital structure only on a statutory basis, not on a GAAP basis. So I don't think Allstate uses them, and that may be why I'm not seeing it in there. So there's their income statement. Cash flow statement, we almost completely ignore it for banks and insurance companies. Are y'all familiar with the term free cash flow? You've heard that, right, in your accounting classes? I don't know, the actuaries, y'all use the phrase free cash flow? Maybe not. It's a pretty important term. So free cash flow is the cash flow the firm produces that they're free to do with what they want to. They can pay dividends, buy back stock, they can invest in a new business, they can build new plants. That's free cash flow. That's how you value a firm. That's the most important part of a firm. Insurance companies, banks don't have free cash flow. The term doesn't work for them. We generally ignore the cash flow statement entirely. Why? Because all this cash they're generating is also generating a lot of risk. They're promising to do something. So it's a very different number. So I don't know anyone that uses the cash flow statement for insurance companies. It's kind of a nonsensical number, but it's all there. They do it just like any other company does. It's just we ignore it. Then you get into what I love. This is where statutory is so much better than GAAP. So if you're interviewing with a company, let's say Peyton or Nathan are interviewing with Allstate, I would go to this page to see what lines of businesses they're selling. So look at these lines. They've got fire. Now, why do they have fire? Isn't that just part of homeowners? And I can't answer that question. We had a UTSA student, one of my first actuaries ever, and he was working in actuary at USA, and he started out in fire. And I was wondering, why are you doing fire? Why isn't that just part of homeowners, right? If your house burns down, that's homeowners. And he explained it to me, and I didn't understand it. I was going to contact him, have him speak to the class, but he quit as an actuary, and now his wife is a wealthy influencer selling something. So I don't know. He got completely out of actuary. He could make more money as an influencer than as an actuary. This is hard to believe. So fire is unique kind of structures that don't qualify for homeowners, but it gets its own line in here. Here's farm owners. You wouldn't think Allstate would do farm owners, but they do. But look at homeowners. $9 billion out of 38 billion. So homeowners is a huge business for Allstate. So just by looking at these schedules, you can see what kind of business they are in. Are they in personal lines or commercial? And you jump down here, look at auto. It's in two different lines. Auto liability, auto physical damage. Now, what I don't know is where's parts B and C. So part A is what? The liability, right? Part D is the physical damage. Where do they put parts B and C? That I'm not sure about. Maybe it's under this first one, who knows? That's 25 billion. So you got 25 billion, about 35 billion of their 38 billion is homeowners and auto, personal lines. So you know who Allstate is now. Pretty straightforward. When I did USA's beta, because USA is not publicly traded, when I did their beta, I went out and I found all the insurance companies using statutory, not GAAP, all the insurance companies that over half their business was auto and homeowners. And those are the companies I used to come up with my beta number. And Allstate was one of the ones I picked because they look a lot like USA. What else do they do? Look, everything else is just pretty small stuff. They have a little bit of commercial stuff, but it's pretty small. They do some inland marine, but most of it, they even do some accident and health. Workers' comp, they even do a little bit. It's possible that workers' comp is workers' comp just for Allstate, that they insure themselves possibly. But most of theirs, if we did this with Chubb, it looked very, very different. Very commercial lines focused. So if you're an actuary or even a finance person, you can see the statutory side is going to give you a whole lot more information on who this firm is. So that gives you the premium, and then they break that up with the unearned premiums. So this is written premiums. So remember, earned premiums is written premiums minus a change in unearned premiums. So you look at written premiums versus earned, it goes from 38 billion to 36 billion. Written is a larger number than earned. Sometimes we use written, sometimes you use earned. And this is how many businesses you can go down to that level of detail. And you try, like on Bloomberg, go into their segment analysis, it's really rolled up to like 5 or 6 things. You got everything you could possibly want on this business. And then they do the same thing with reserves or unearned premiums. They give you detail and just detail after detail. Here's premiums written. They give you the detail there by affiliates and non-affiliates. Reinsurance. Here's what Kirby was talking about. What is reinsurance assumed? That's the reinsurance they sell to other people. They get the premium. Reinsurance ceded. That's reinsurance Allstate buys from another insurance company. You can see they're on both sides of this. They even do some to some of their subsidiaries. Incredible, incredible detail. Here's the investment exhibit. Underwriting investment exhibit for kind of losses. Here you have losses percentage of premiums earned. So you can see which businesses did poorly. Here's a business that had a loss ratio of 145%. That was farm owners, multi-peril. So again, just massive, massive information. There's another whole page on reinsurance. Another page on loss adjustment expenses. Here's the investment income exhibit. Here's what I was talking about on real estate, that they pay themselves interest or rent on their own property that they own. They have an exhibit of the capital gains as well. Schedule F is a reinsurance schedule, and it goes on forever. How many pages is this thing? It's only 106. Why is this so short? Because this is the consolidated one. You go to Allstate, the parent company, you're going to have several hundred other pages because it lists every single investment that they own over and over again. So massive, massive. Schedule F. Schedule F is all the information on their reinsurance. Schedule H is for accident and health, which I thought that was sold by life insurance companies, and it is, but there's some residual health insurance that's sold by P&C companies. So you have that in there. And then Schedule P. So we've been talking about Schedule P. Look at Schedule P. I love Schedule P. You have the summary, and not to blow your mind, but we have a Schedule P for every line of business. Isn't that cool? It's just amazing the amount of data you can do. Here's commercial. So all of this, if you buy that SNL database, all of it is available on a computer. You can download it, bring in the data for thousands of companies and do all kinds of analysis. Pretty amazing. There's a few of these I want to show you. I'll show you on Wednesday. Especially there's a premium exhibit I want to show you. I think is really, really interesting. It shows you how much premium they collect from each state. So it shows you their main business. And then their Schedule Y I want to show you, which shows you the holding company and all of that. I might bring up Allstate unconsolidated so I can show you some of the Schedule D. So there's a few things I want to show you so you know they're in there. This is called the Yellow Book. I don't even want to guess why this is called the Yellow Book. Any guesses? Because the cover is yellow. On the life insurance side, they call it the Blue Book. Any guesses on that? So it's blue, and then the separate accounts is the Green Book. So yeah, Tim used to keep the yellow books for USAA. He had the history of them back to the 50s. It's incredible. I used to borrow those books all the time and do all kinds of analysis until we got SNL, and then I could pull the data myself. It's an amazing amount of data. You can see why I get so excited about statutory. You cannot get this kind of information on any other kind of company in any other business. It's really, really amazing. All right, we'll stop it there. Did y'all got my email on the cat bonds? Did I come over? Okay. And y'all got bond before. All right. I want to finish up the accounting, but I'm going to do it next week. I want to show you all this last math question so you'll have everything you need for the exam. Start getting ready. Insurance there's two types. There's life insurance, or two categories: life insurance, property and casualty. The life insurance side doesn't really worry about inflation that much because their products are usually fixed when they sell it. Property and casualty insurance, inflation's a big deal. So in this class, I like to show bootstrapping the yield curve because it's a really powerful tool, and it's something that applies. You could certainly use it on the investment side. We'll talk about investments later in the class, but looking at bootstrapping the yield curve. So first of all, what is the yield curve? So you probably, and oh, money in banking. Did y'all take money in banking? Talk about the yield curve. You probably have the theories about why it's shaped like this. Let me see if I can show you a more normal one. So normally yield curve is upward sloping, whereas where the longer term rates are higher than the shorter term rates. This is back in 2017. The normal is when you compare the 10-year to the 2-year. Here you can see the 10-year is 224, the 2-year is 120. That's what we call a steep yield curve. The norm is 70 basis points. So if the 2-year is 4, the 10 years would be 4.7. If the 2-year is 2, the 10-year would be 2.7. So 70 is the norm. This is a fairly steep yield curve. We had in yeah, I don't know if I can get us. In 2019, the 10-year is still upward sloping. I don't know if I can get you a really negative one, maybe 2007. No, I can't remember when it went negative. That one's pretty negative. So here, the 2-year is 482 and the 10-year is 481. They're about the same. So, so the norm is for it to be upward sloping, the 10-year to be about 0.7% higher than the 2-year. So today we have really bizarre looking yield curve. And a lot of this has to do with the Fed and Trump, obviously, and tariffs and everything else. So the 2-year is really low, 3.8%, and the 10-year is pretty high at 4.4. Oh, that's about that distance between those two is about normal. So 381 versus 440. So that's about 60 basis points. That's pretty normal. What's not normal is this part here dropping down. And the reason for that is right now the Federal Reserve, and you can see, I think I've shown you on this site before, but if not, the CME Group, Fed Watch. It's a great website if you don't use it. But right now, they're expecting the Fed to cut rates. This is showing what markets believe. They expect the Fed to cut rates from 425. You can see a lot of people think they're going to cut it from 425 to 325 to 300. So that's 100 basis points or more. You notice that it's come down though some. They've kind of gone from it coming a bunch to cutting just 75, but they still expect them to cut rates. And all of that is because the market has suddenly got concerned about recession. But if you look at what they expect, say in June, they don't expect much cuts in the next 6 months or so. So all the cuts are going to happen by the end of the year. And because of that, the yield curve here for the next 3 or 4 months is not coming down much at all. But people are expecting the Fed to cut rates a lot about a year from now or 6 to 9 months from now. So you're seeing this big drop here. But then the 10-year is coming back up because even if they do cut 6 months from now, they're probably going to have to raise them again before the 10 years is up. So that's what the yield curve is giving you. We also have tips. Tips are Treasury securities that pay real rate plus inflation. And so they have much lower yields. But here's the tip yield curve right here. And right now, the 10-year tip is paying 2.08%, and it is pretty steep. This rate, now you think about a tip, it pays you inflation. So it sounds like, wow, that's really good protection from inflation. How did tips do in 2022, high inflation? How did tips do? You would have thought they had a great year, but they did horribly. The reason they did horribly is because tip yields were actually like negative 101%. The real yield was negative. And so what happened in 2020, you got a lot of inflation, but the real yield rose from negative 100 to positive 2. So you lost a lot of money on the real yield moving. So tips have been a strange instrument. They haven't been around that long, just since 2003. But there's the 10-year tip is paying 2.08. the 10-year treasury is paying 4.4, so there's a 2.2 difference between those two. If you think about the difference in those two, we have the nominal, just paying 4.4%. This is the 10-year treasury. What's the nominal? It's the one you see on Yahoo Finance. It's just a regular 10-year bond. It's called nominal because it's paying you a fixed rate that cover both the real yield and inflation. And then you have tips. They're paying 2.21%. So what is that difference? Well, the tip is going to pay you 2.21 plus inflation. Nominal is going to pay you 4.4 no matter what inflation is. So could this be expected inflation next 10 years? It certainly should be close to it. There could be some premiums, like you might have a little bit of risk premium in the nominal because you don't get compensating for inflation. You know, there could be things like that going on. But there's a more sophisticated way to look at this, and that's what's called, what the Fed looks at is the break even for inflation. That's what we're going to calculate, because what it's telling you is what is this bond market expecting inflation to be, say, in 5 years from now, 10 years from now. This number tells you the difference today, but there could be a lot of noise in this number. The break even tries to go out into the future to figure out that number will be out several years. Supposedly the Fed looks at the forward 5 year in 5 years. We'll talk about that. It gets a little confusing. Essentially, they're asking, what will inflation, 5-year inflation be 5 years from now? So essentially, what will inflation be from year 6 through 10? That tends to be the number the Fed looks at. If that number gets above 3%, if the markets are telling the Fed that they think inflation is going to be 3% for an extended period of time, they're probably going to be raising rates to get inflation down because that's just too high. I know inflation has been above 3, and that's the shorter term. So we're talking longer term. In fact, people have said that Bernanke, who was the previous Fed chairman, that he had this break-even number, just he looked at it every single day. It was one thing he watched really, really cautiously and closely. So what we're going to do is what's called the forward curve. Have y'all heard of the forward curve before? Have y'all calculated forward curves yet in any class? So you need to know the forward curve. If you're a finance major, I would know it. If you're an actuary, especially if you're going to be on the life side, you need to know a forward curve. And interest rates are extremely important on the life insurance side. So life insurance side, it's all about interest rates. The P&C side is worried about inflation. So if you're an actuary, you really need to know both. I call it bootstrapping. I don't know where that term came from. It's what I've always used. I don't know who told me that term. It doesn't make any sense to me because I know what, pulling someone up by their bootstraps. I've heard that phrase, but I don't know why it's called bootstrapping. When I do the calculation, I don't know what it has to do with boots or bootstrapping, but I'm going to use the term. I'm assuming it's the correct term. So here's our numbers that we're going to use. These are old numbers. We're going to do this exercise first, and then what we'll do is we'll use current today numbers and redo it. So when I pulled this a couple years ago, the 5-year treasury was paying 0.81%. Tips were paying minus 172, which is just crazy. So you would get minus 1.72 plus you would get inflation. Why would someone lock in a negative real return for 5 years? I don't know. The 10-year was paying 157 with the real yield, the tips yield of negative 76. I used to think it was impossible for the 10-year tips yield to go negative, and the market proved me wrong on that. Definitely did. And then the 20-year was paying 216, and the 20-year real yield was even negative 0.23. So let's just look at the nominals. So there's two things that you could do. You could buy a 5-year nominal today, and when it matures, buy another 5-year treasury. So essentially have a 5-year treasury for 5 years, it matures, you buy another one, 5 years, or you can just buy a 10-year treasury. Those are your two choices. Let's say that's all, you need money to invest for 10 years. And you decided I only have two choices. I can buy a 5-year treasury and then another 5-year treasury. I can just put my money in 10-year treasury. What bootstrapping says is the stock market, the bond market, the bond market should be indifferent between those two choices. They should price their bonds so there's no difference between buying a 5-year and a 5-year or just buying a 10-year. They should be indifferent. If one was obviously better, then you would do that one and short the other one. So what bootstrapping says is if we're indifferent between doing these two things, what does the 5-year treasury yield have to be in 5 years so that we are indifferent between them? You can kind of guess the number if you think about it, because if this is going to pay you 157 for 10 years, and this is going to pay you 0.81% for 5 years, what would you need in 5 years so you're indifferent between the two? We definitely need a lot more than 1.57. Because you make 0.81 for 5 years, you have to make a lot more than that the next 5 years, so you end up with 157, right? So let's look at it. I'm going to add some space here because I want to work it again. This is the one. This is on Canvas, so you got it worked out on Canvas already. So let's say you invest $1,000 in the 10-year. The 10 years paying 157, so you take $1,000 times 1 plus 0.0157 raised to the 10th. That's the value of the 10-year in 10 years. So if you invested $1,000 today at 157, in 10 years, you have 1,168.57. If you did the 5-year, .81%, I'll put the formulas in there. You would have $1,000 times 1 plus 0.081 raised to the 5th. So in 5 years, your $1,000 is going to mature at 1,041.61. What rate would you need so that when you buy another 5-year bond in 5 years, you'd end up at 1,068.57, so you'd be indifferent. So the forward 5 years, let me show you the formula so you can see how it works. You're going to take the 10-year maturity divided by the 5-year maturity, raised to 1 divided by 5 minus 1. So you would need 2.34%. Now let's see if it works. So you understand we invested $1,000 a day. 5 years from now, we have 1,041.16. We're going to take that 1,041.16 and we're going to invest it at 234. So 1,041.16 times 1 plus 0.0234 raised to the 5th. That gets us, it's not exactly the same because of rounding, so let me not round. So if 5-year treasuries are paying 234 in 5 years, we'd end up with the exact same portfolio, whether we bought the 10-year or we bought the 2 5-years. Is everybody following me on that? It makes some sense, right? If you're going to only make 81 basis points or 0.81% for 5 years, you're going to make a whole lot more in 157 so that those 2 5-years give you the 157. So you make 0.81% for 5 years, you make 2.34% for 5 years, and you end up in the end making 1.57%. What the market is telling you, this is the forward curve. Market is telling you they think 5-year treasuries will be yielding 2.34% 5 years from now. And here I actually used to type the formulas, but I don't know, I like the formula function better. So I don't know if I can show you the forward curve. I should probably, let's see if we can get the forward curve. Yeah, I'm not seeing a good forward curve. Actually, the tips that I brought up shows you the break-even inflation, which I'm gonna show you. So that is somewhat a forward curve. If you go on the Bloomberg and the FSC and go to they have a forward curve, you can bring it up and it will show you all the different forward curves that are out there that you can actually get to. Yeah, I'm not seeing a good forward curve. It's usually shown as a matrix, so I should have said forward curve matrix. That might look better. This is usually what it looks like, something like this. Where it's essentially saying, okay, 1 year from now, this is what we think the 5-year treasury is going to be. 2 years from now, this is what we think the 5-year treasury is going to be. 1 year from now, this is what we think the 2-year treasury is going to be. 2 years from now is what we think the 2-year treasury is going to be. You essentially have all these different combinations that you can bring together. Now, how do you do it actually as a formula? So let me just show you the formula. It's exactly what I just did, but I'm going to take 1 plus the 10-year, 157, raised to the 10th, divided by 1 plus the 5 years, raised to the 5th. That entire thing, you're going to raise it to 1 divided by, and here what I do, gotta be real careful because I'm using 5 and 10. So it's like, when does the 5 come in? I'm not raising it to the 5th power because it's a 5-year treasury. I'm raising it to the 10th year because that's how far out in the future I'm going. So I'm going out 10 years minus 5, minus 1, and that gives you that 233. So I'm gonna do another example using the 20-year versus the 5-year. 20-year versus the 5-year. Let's see. Boy, I bet y'all can't get this in this first try. It's usually pretty confusing the first time people see it. I'd be really impressed. If we compare the 20 to the 5-year, what forward number are we looking for? Huh? Yeah, starting with 1,000, but what interest rate are we, what forward rate are we getting? We compare the 20 to the 5. When you compare to the 10 to the 5, we're looking at 5-year yields 5 years from now. When you're comparing the 20 to the 5, what are you looking for? It's really tricky. So you're still saying you're looking for a rate 5 years from now. What rate are you looking for 5 years from now? If you compare the 20 to the 5. So for the 10 versus the 5, we said, are we doing 5-year treasury? So we're going out 5 years. What rate are we looking for? We're looking at the 10 versus 5. So we take 10 minus 5. So we're looking at the 5-year rate 5 years from now. Same thing here. 20 versus a 5. All right, we're asking what rate in 5 years? 20 minus 5 is 15. So if we compare the 20 to the 5, we're asking what will the 15-year treasury be 5 years from now? Right? So if we do that, the formula is going to be, remember the numerator is the 1 plus the longer one, the 20-year, raised to the 20. All right, y'all got the numerator? 1 plus whatever that longer number is, raised to whatever time that is. All right, that's your numerator. Your denominator is going to be the shorter one. 1 plus 0.0081 raised to the shorter. All right, that's always going to be the case. Essentially, that's asking how much do you need to earn between years 15 and 20. So the tricky part is the denominator. You're going to raise it to 1 divided by, I always, rather than just picking a number, I just do the longer year minus the shorter year. In this case, 20 minus 5. If you always do that, the habit, whether it's 10 minus 5 or 15 minus 5 or 20 minus 5, whatever the longer bond is minus the shorter bond year, that will give you the right number. That gives you 2.61%. So what does that mean? If I took $1,000 and invested it at 2.16% for 20 years, how does that compare to me doing $1,000 for 5 years at 0.0081? And then I take that when it matures and I invest it at 1 plus 2.61 for 15 years, and end up with the same amount. So this is where it gets really confusing. This is the 5-year forward 15-year treasury yield. Isn't that confusing? Or especially when I can't spell forward. All right, so that 261 is what the market thinks 15-year treasury will be 5 years from now. It's that forward 15-year treasury. Yeah. The one I'm going to give you is really straightforward, but I'm giving you more complicated ones, and you'll see the exam. I'll show you an exact exam question. You really should learn this outside of this class, because if you're a finance major, you don't know this. You really should know. I always remember the story. Some of y'all have heard this story before because I tell it a lot. But I was sitting at my desk, in my office, minding my own business, and the phone rings. I pick it up. I usually know when the CEO is calling me because it says his name on it, but he was in a conference room, and he's got me on, the volume on so the whole room can hear. He's like, Ron, no one in this room knows how to do the forward curve. He was really mad. There's a bunch of accountants. He says all these finance people, they weren't finance people, they were accountants. Does none of them know how to forward curve? Can you teach them how to do it? And I would have lied and said, yeah, I know how to do it. I did know how to do it because I had just taken the CFA exam, so I knew how to do it. But he was mad because all these accounting majors didn't know how to do a forward curve. I never heard of it. And so, yeah, it's like, yeah, sure, I can do that. No problem. It's pretty common in finance because it gives you a really good forecast of interest rates. So if you're ever in a job where you need to forecast interest rates, let the bond curve forecast it. Why is that? Well, we talked about it in our risk management class. Why are bookies such good forecasters? They do it all the time. They have skin in the game. Bond managers, they do it all the time. They have skin in the game. They get immediate feedback. So yeah, the bond market is a pretty good predictor of future interest. Not perfect, but they're a lot better than economists, that's for sure. And so essentially the bond market's telling you, we think the 15-year treasury is going to be 2.61% 5 years from now. I'll talk about what do you do if you disagree with them, but that's the forward curve, right? Now you have more choices because you also have the tips. And the forward curves work exactly the same way on tips. The challenge you have with this problem is that the tip yields are negative, but that doesn't change your formula. You still use the same formula. Fortunately for your exam, you won't have negative numbers because the yields are back to normal. So how do we get, what does the market think the real yield will be at 5 years from now? It's the same formula. We take, what do we put in the numerator? 1 plus what? The longer year or the shorter year? Longer year. In this case, it's plus minus 0.0076. Raised to the what? 10, right? I'm going to do 10 versus the 5 again. So the numerator is always 1 plus that longer rate to its time, divided by what's in the bottom. What rate do I put? 0.0172 raised to the what? The fifth. You take that whole thing and you raise it to the 1 divided by, well, you got a 10-year bond and a 5-year bond minus 1. So what they're saying is 5 years from now, the real yield should be 0.21%. So even with negative numbers, it works. You just plug it in as a negative number instead of positive number. It still works exactly the same. So what can we do with this? Let me do the forward nominal. That's the forward real. The forward normal again is 1 plus 0.0157 raised to the 10th divided by 1 plus 0.0081 raised to the 5th. Take that whole thing and raise it to the 1 divided by 10 minus 5 minus 1. So in 5 years, we think the 5-year treasury yield is going to be 2.34%. In 5 years, we think the real yield is going to be 0.21%. What is the difference in those two? That's known as break-even inflation. 2.13. That's the inflation rate 5 years from now that makes you indifferent between the nominal bond and the tip. This is the number Bernanke, and I bet even Jerome Powell is using this number. This is the number that tells you what the market thinks inflation is going to be 5 years from now. I would have this number on my screen every day as a finance major. So let's see what it is today, because if Jerome Powell is going to be panicking with inflation, if this number is above 3%, if the bond market thinks inflation is going to be above 3%, he's going to be panicking. Let's see if he should be panicking. So what numbers do we need? We need nominals, and we need tips. We need the 5-year. We need the 10-year. And that's the reason I use the 5 and 10-year. It gets confusing because you got 5 and 10, and you got 10 minus 5, which is also 5. So that's why it gets confusing. But that's the actual number he uses. So let's get the top nominal rates. So the 10-year, am I back to the day? Looks like I am. I don't know why it's like that. So today the 10-year was 4.4%. Man, it's getting back up there. It's been great. I don't know if y'all been watching the treasury curve. The 5-year is 4%. So just off the bat, is the market expecting the 5-year yield 5 years from now be higher than 4.4% or lower? If you make 4.4% for 10 years, but you only make 4% for 5 years, what do you have to make the next 5 years? It's going to be more than 4.4%. There's no way you come out ahead. All right, let's look at the tips. Fortunately, tip yields are positive today. So the 10-year is 2.08. And the 5-year is 1.63. So we need the forward rates. How are we going to do that? We're going to bootstrap the yield curve. That's what I say. I'll put it in Google and we'll see. Bootstrapping is method of constructing a zero coupon yield curve from the prices set of a set of coupon bearing products is used to fill in the missing figures in order to derive the yield curve. Given the par yield value, a linear interpolation is used to fill in the gaps from missing maturities, and then used to construct the theoretical spot yield curve. Bootstrapping, see that? Not, yeah, that's not exactly what I'm doing, but that's fine. That's a fine definition. Wikipedia is a method of constructing a zero cone fixed end curve with the price. That's almost the same wording. They're implying it's the spot curve, but I'm saying it's the forward curve. But so I don't know. I probably should stop using the term bootstrap. I was probably taught it incorrectly, but I've been using it for 30 years, 40 years, so I can't stop. All right, so let's get the forward rate. So remember the forward rate, it's going to be, the numerator is always going to be 1 plus the longer yield raised to its n divided by 1 plus the shorter yield raised by its n. You're going to take that entire thing and raise it 1 divided by n longer minus n shorter, and then minus 1. That's the whole formula. You can spell yield correctly if you like. So whatever the longer yield is to its time divided by 1 plus the shorter yield to its time raised to the 1 divided by the longer time minus the shorter time. Be real careful. We're not using 5 here because it's a 5-year treasury. We're using 5 here because 10 minus 5 is 5. Okay? Sorry it's so confusing, but we got to use this because it's what the Fed uses. I would use a different group of yields if I could, but this is what the Fed's using. So here we're going to take 1 plus 0.044 raised to the 10th divided by 1 plus 0.04 raised to the 5th. Does that look right so far? We'll take that entire thing and raise it 1 divided by 10 minus 5. It's 1. That's going to be like 4.8, 4.7, something like that. It makes sense that it's 4.8. You'd invest 5 years at 4%, then the next 5 years at 4.8%. That should give you a 10-year return of 4.4. So you should be indifferent between buying the 5-year, reinvesting at 4.8, or just buying a 10-year at 4.4. Let's do the same thing with the tips. Now we got actually real numbers. So 1 plus, y'all tell me the rates if y'all are with me. What goes in the numerator? 8 raised to the what? All right, good. Divided by what? 163 raised to what? All right. All right, we're going to take that entire thing and raise it the same thing we just did. 1 divided by the longer minus the shorter. That whole thing minus 1. Now look at it when you do an exam, look at it and see if it makes sense. When the yield curve's upward sloping, the forward rate has to be higher than the longer term rate. Has to be, because you got to get that and that, 5 years of that, 5 years of that, in order to get 10 years of that. It's going to be a little easier for you on the exam because the yield curve is upward sloping. It can get really confusing when the yield curve is downward sloping, and it can really look bizarre. But you've got a more normal number, plus you have positive numbers here. So what is the break-even inflation? It's just going to be the forward rate minus the tips. 227, what does the Fed want? 2%. So the bond market isn't real confident in the Fed right now, but at least it's below 3%. So it hasn't gotten dangerous. You could actually do this in Bloomberg or something where you're looking on over time and seeing how it moves around over time. It could get really, really interesting when the market's worried about inflation coming from tariffs and it's worried about recession coming from tariffs. So you're going to have inflation with a weak economy. No telling what the yield curve is going to look like. I hate the word tariffs. I can't say tariffs without making it sound like terrorist, but tariffs to really emphasize the two syllables. All right, really powerful number. Now, what could you do with this information? Well, you can actually make a bet today. All right. Let's say you believe rates will be lower in 5 years. So the market's telling you they think the 5-year rate's going to be higher in 5 years. You say, no, they're wrong. We're going to have a recession. Things are going to slow down. The 5-year is going to be well below 4.4%. So what could you do? Well, first of all, would you buy the 5-year? You think the 5-year rate 5 years from now is going to be below 4.4%? What would be the smarter thing to do? If you only have two choices, you can buy 2 5-year treasuries or 1 10-year treasury. Which would be the smarter choices? Do you think 5-year rate's going to be lower? Would you buy the 10-year or would you buy the 5-year and reinvest? Well, what happened? You buy the 5-year, it's 4%, and in 5 years, 5-year yield is low. It's only like 3.9%. Would that be a good investment? Or would you rather locked in 4.4% for 10 years? I'd much rather buy the 10-year. Well, what does that mean? Well, you think the 5-year is a horrible investment. What do you do with something that you think is a horrible investment? Do you buy it or do you short it? You short it. So what would you do here? Buy the 10-year and short 5-year. All right, now how would that work out? So you buy the 10-year. So you're going to make 4.4% for the first 5 years. So at the end of 5 years, you're going to have that built up. Yeah, I can't remember my rates, 4%. And you have the 4% for 5 years. I really shouldn't do it like, don't do it like that. Yeah, it gets really, really tricky because of market values. Yeah, let me do it a little different way. So you buy the 10-year and you're making 4.4% every year. You short the 5-year, you're paying 4% every year. What will the 5-year be worth in 5 years? It's going to be worth exactly $1,000, right? So with the 5-year times 0, you invest $1,000. You make $40 a year for 5 years. And at the end, you get your $1,000 back. What happens with the 10-year? Invest $1,000, you make $44. And what happens at the end? It's still got another 5 years to go, right? So if you short this and you buy that, what was your investment? So you sell the 5-year, you short it, so you get $1,000. You buy the 10-year, cost you $1,000. How much did you invest? 0, right? You're not out of any money. That sounds pretty good. Every year, you make $4, right? How much will the 5-year be worth at the end of 5 years, it's gonna be worth $1,000, right? It matures at $1,000. You paid 1,000 for it, you got your $40. Plus you get matures at $1,000. What's gonna happen with the 10-year? You don't get your 1,000 back in 10 years, right? You're gonna still get $44. I mean, is that 5 years? But then in 10 years, you get your $1,000 back. So at the end of 5 years, so you've made zero investment, you made $4 every year. 5 years. At the end of 5 years, this treasury you have to buy back at $1,000 because it matured. $1,000. So how will this 10-year treasury look? If you think what is this 10-year treasury at this point? It was a 10-year treasury here. Now we're 5 years along the line. What is this 10-year treasury now? It's now a 5-year treasury. How would you value this 5-year treasury? Well, if the interest rate is 4%, you would discount that treasury at 4%, but it's paying you 4.4%. What did y'all learn in finance? If you're buying a treasury that's paying you 4.4% and your discount rate's 4%, what's the value of that treasury going to be? More than 1,000 or less than 1,000? More than 1,000. It's going to be a premium bond, right? If you think the 5-year treasury yield is going to stay at 4%, this 10-year treasury is going to trade at a premium, which means what? You got to pay $1,000 to close out that 5-year treasury. But how much is this treasury going to be worth? It's going to be worth more than $1,000. So you're going to make a gain. So you could sell the 10-year here at a gain. How much of a gain could you do? Well, we could I'll do it kind of high level. What's the rate? 4%. Number of periods, we'll just do 5. What's the payment? 44. What's the future value? 1,000. So that treasury, now it's a 5-year treasury. It's now worth 1,017. So you sell the 5-year, you buy the 10-year. So you invested $0. I'm sorry. Well, why do we think treasuries? What do we think the 5-year treasury yield is going to be in 5 years? So this is now a 5-year treasury. We think 5-year yields are going to still be 4%. All right. So we invested 1,000 of our own money, but we got $1,000 by shorting the treasury. So we have a zero investment. What's going to be return on investment? Can you calculate return on investment if you invest 0? The actuaries, what happens when you divide by 0? Become a big number, right? So it's an infinite return. You're making $4 every year. That's kind of nice. But at the end of 5 years, this one matures at $1,000. That's how treasuries mature. They mature at par. So you got to spend $1,000 to close that out. But the 10-year treasury is now a 5-year treasury, but it's paying you 4.4%, but your yield is still only 4%. In this case, you're going to actually have a gain. So you could, at the end of 5 years, you could buy this one back, but then you're going to make $17.81. So you end up making $4, $4, $4, $4, $4, plus another $17.81. That's a really, really good investment. All right. So you can today, if you disagree with the market says the 5-year rate is going to be 4.8%. If you think it's going to be lower than 4.8%, you can actually come out ahead by shorting the 5-year and selling, buying the 10-year, shorting the 5-year and buying the 10-year. What if you think rates will be 5.5% in 5 years? Now what do? You don't think the 5-year treasury is going to be 4% in 5 years. Now you think it's going to be 5.5%. What was our break even? What was our forward curve? 4.8. You think rates going to rise more? What transaction would you do here? And yes, it is exactly the opposite of what we did. So what would you do? You would buy what? Buy the 5-year and short what? 10-year. So here you have here you're making $40. Here you're paying $40. So you come out behind $4. But now when we look at the treasury, our rate is now what I'd say 5.5. Memory periods is 5. Payment is 44. Now we have a discount bond. So we sold that 10-year treasury. Now we got to buy it back in 5 years. We get to buy it back at 953.03. It's true, it costs you $20 to do that, but you're going to make $47 at the end when you buy that 10-year back. Because what is the 5-year going to mature at? $1,000. This one hasn't matured yet, so it has 5 years to go. Would you do this investment? You're out of cash a little bit. At the very end, you make $47, so you're up about $37. How much did you invest to get $37? Zero. How much, if you knew for sure that 5-year was going to be 5.5%, how much of this transaction would you do? $1,000, $10,000, if you knew with absolute certainty. I know on this one, I would do a few $1 billion, right? On this one, you're never behind. You make money every year, and then at the end, you make an extra $17. I'd try to do $7 trillion if I could on that one, right? Because there's no risk if you know for sure what rates are going to be in the future. This one's a little trickier because you are out money. So if you do $1 trillion, you're going to be out a whole lot of money for those first few years. But there's a special kind of bond we can do this with and not be out of cash. What kind of bond would that be? You could do zero coupon treasuries. Right? If you do zero coupon, you don't have those coupon payments, then it's all about the price. And it would be an absolute risk-free transaction, assuming you knew what rates were going to be in the future. How good is this 4.8%? Well, again, people have skin in the game. I know these markets extremely well. And as a result, it's probably not a bad forecast. They are expecting interest rates to be higher in 5 years from now. A few years ago, when would they expect them to be lower? If they're expecting a recession, the Fed to be cutting rates, they would expect rates to be lower. So anytime the forward rate is below the 10-year, you're expecting rates to fall. That's usually pretty negative for economies, because we expect Fed to really step in and cut rates, especially that far out, 5 years out from now. All right, let's practice this again, because y'all giving me the I'm not exactly with this guy look. So let's see what would be an interesting point. I don't know if I can get tip yields back that far though. I've had trouble getting tip yields back historically. Usually I can get them for like the 10-year or the 5-year, but to get all of them together in one place is really tough. So I'll just make up some numbers, but so y'all try this, y'all practice it. In fact, I think I've got an example right here. So let's try this one. Write these down and just try. We'll try another one on Monday as well to get you some more practice. I'll send it out to you in advance. So the 5-year treasury is 1.62%. The 10-year is 1.78%. The tip is 12 basis points and 17 basis points. Y'all know what I mean by basis points? Just assume y'all are comfortable with basis points. So 12 basis points, you take 12 divided by 10,000, so you get 0.0012. And practice it on your calculator if you're not used to using exponents on your calculator with parentheses, make sure you put the parentheses in the right places. When you get an answer, make sure it seems reasonable. The 5-year is lower than the 10-year. So it means your forward rate should be higher than the 10-year. Shouldn't be radically so. You're not going to get a 3 or 4%, but it should be lower. So on the exam, I don't count out for math errors unless it's a math error where you should be able to say, wow, that can't be right. So on the exam, you get a number, you say, well, that can't be right. It's got to be higher than 1.78. You can put a note. You must have a math error. You know, as long as you acknowledge that, I'll give you credit for not take off for the math error. All right, let's try it. So what's the forward nominal? Someone give me that formula. What's in your numerator? Say it really loud, sorry. 1 point. And the 10, all right. What's in your denominator?
Or 1.0837. Oh, sorry. 1.01622.
That's two. The fifth. All right, we're gonna raise all of that to what? And the last thing, don't forget the subtract one, right? Did y'all get 194? I got 194. All right. Does that seem reasonable? That looks about right, doesn't it? 194. All right. The forward, we call this the forward real. The tip is the real yield. Right. So Natalie's got it. Someone besides Natalie can do this. What's in your numerator?
0.0012.
0012, the 10th, right? It's the denominator. Oh, wait, that's not right. Wait, what did you say? 1.0 what?
I said 1.0012.
So what do you want in the numerator, the longer term or the shorter term?
Longer, sorry.
Yeah, 1.7, all right, good. And then the denominator?
1.00112.
Okay, all right. To the, all right. Gonna take all of that, raise it to the what? Someone just say it, so now you're breathing.
1 divided 10 minus 5.
All right. And then the last thing, -1. You're expecting something higher than 17, but not radically, so maybe 22 or something like that. 22, and that's what I got. And so then what is your break-even inflation? You just subtract the two of them. Which was a very low break-even. Why? Because this was probably from a couple of years ago when the market was expecting deflation and recession. So 2021, 2022, 2020 and 2021, break-even inflation is really low. 2022 then hit, and man, it just all came apart. But at that point, they're expecting low inflation. Now, not everybody believes this is break-even inflation. So I learned this break-even inflation. I went to an inflation conference, if you can believe there was such a thing. The whole week was inflation conference. Everybody there was an economist. So I was by far the dumbest person in the room by a large margin. Most of the presentations were way over my head. It's like people were walking up with these massive formulas. I'm shaking, when you shake your head, you have no idea what they're saying. You're like, yeah, that, and you do your eyebrows like, wow, that's really interesting. But this presentation I understood because the math was really simple on this. And the guy who did this presentation, I don't remember his name, he was an economist. I actually called him after the conference. He was really upset I called him, but I still got what I needed out of him. He said, this isn't quite what the market thinks inflation is going to be in 5 years. He said that there's a risk premium. That when you buy nominals, you're really exposed to inflation. So you need a little extra return to induce you to do that. So he thinks the risk premium at the time he did the present, he thinks it's 25 basis points. So he would say the real break-even inflation is more like 147, but you don't have to worry about that on the exam, but just to let you know, some people think it's not exactly the difference. I do think the Fed is focused on that number. At this point, they weren't worried about inflation because the market was expecting inflation lower than what they were targeting, so they felt good. We actually started doing this in our pension plan because we had to have an inflation, long-term inflation assumption. We started doing this for the pension plan, and the actuaries had no, I mean, the auditors had no problem with us doing that because it's very well accepted. So it's a powerful tool. What this means is if you have a job where you need to forecast interest rates or forecast inflation, you can sound like the genius in the room and say, why don't we just use the forward curve? Just watch everybody look at you like, wait, I thought you were the newbie. How can you say that? So, it's a powerful thing to say. And then make sure you remember how to do it. Don't volunteer and you can't remember how to do it. When I was at USA, we were paying a few $1,000s for an inflation and interest rate forecast. And I quickly discovered that was all they were doing was giving us the forward curve. So I said, let's cancel this. There's no reason to spend money to do what we just did here for free. So I just started giving them the forward curve and we saved a bunch of money on that. They pretty good business for you, right? That you sell this for $1,000 and you just say, hey, I got this forecast of inflation. But it's very, very straightforward to do. You can look up, see, they even have the break-even inflation here. So remember when we did our analysis, when we did the current yields, we got a break-even at 227. They're showing a break-even of 232. It's slightly different, but I'm not exactly sure which date this is. If it's exactly the 20, well, it says it's the 23rd. So I'm not exactly sure. It's slightly off, 332. I do think sometimes my numbers are slightly off because these bonds pay twice a year, not once a year. And the way I'm doing it essentially assumes that it's twice a year. How would you change this if it's twice a year? We'll see if that makes a difference. Instead of doing 4.4 to the 10th, what would we do? 4.2 divided by 2 to the what? The 20th. And then instead of 4%, we do 4% divided by 2 to the 10th. And I don't know about the end of that. That would work. Same thing here. Divided by 2 to the 20th. By 2 to the 10th. That gives us 231. Is that closer? They got 232. We're getting in the ballpark. So I'm not that real picky. I've always noticed my numbers are slightly off from what Bloomberg shows. And I do think it's because I'm assuming annual. And I know treasuries never pay annually. They always pay twice a year. That does have an impact because you got that kind of compounding effect going on. So it's pretty close. That does look like, I didn't notice this April 23rd there. That looks like we are getting today's break even. You probably want to be precise if you're going to do this in Bloomberg and keep track of it to adjust it correctly so you get the right number. It is interesting that the short term is 3%, but the short term is not what the Fed's really focused on. They're really focused on this 5-year forward. And why is that? Well, the short term, especially for going into the summer, we know that oil prices, gas prices tend to rise in the summer. There's these short term phenomenon, and the Fed wants to look through that and look longer term. So they 5 years has tended to be theirs. You notice on the break even inflation how constant it is once you get out past 5 years. You know, the low is what, 2.216. I don't know what the high is, I guess right here, 237. It's pretty consistent. You get noise in the short end, and then it gets pretty consistent after that. You probably can get the forward curve. I wish I could actually show you current treasury. Boy, I cannot type. It should be able to show it to you somewhere. Y'all know what SOFR is? Have y'all learned SOFR yet? My risk class, right? Y'all did SOFR. What did that replace? You remember? Like getting y'all ready for interviews. LIBOR, yeah, it used to be LIBOR, London Interbank Offer Rate, and that got replaced by SOFR. Why did it get replaced? Because there was some corruption going on with LIBOR, where banks in 2008 they were lying about their rate in order to protect their business, because it was a rate that, you know, you just kind of called it in and say this is a rate. And people were suing because of that. And I was tempted to sue from USA standpoint to discover that whatever they were lying about was actually helping us, not hurting us. I was like, I don't think we should sue. They have the yield curve, finding the forward curve. I don't know who this pins forward is. They'll tell me what I'll get. Doesn't look like, well, that's on the SOFR rate. Yeah. But you can definitely get it in Bloomberg. If you just go into Bloomberg, you can actually type forward curve in the search function and we'll bring it up. If I remember, I'll try to remember between now and Monday to actually do a print screen of Bloomberg's forward curve so you can see it. It's all there. How many do you have? Well, if you think about the yield curve, we've got it here somewhere. You can compare the 3 month to the 6 month. That gives you the forward 3 month rate. You can compare the 1 month to the 7 year. That gives you, well, y'all tell me. You compare the 1 year, I'm sorry, 1 year to the 7 year, what are you getting? You're getting a forecast for an interest rate when? A year from now or 6 years from now? Be real careful. So if you're using the 1 year as your shorter, you're making a forecast for 1 year from now. And which rate are you forecasting for 1 year from now? The 6 year rate. So if you compare the 7 to the 1, I can tell that's kind of tricky. I still have to stop and think about it. Compared to 7 to 1, you're making a forecast of interest rates 1 year out, and you're forecasting the 6 year yield. You're saying this is what the 6 year yield will be. Let's give you another try. You compare the 7 to the 10. What are you forecasting? Which rate and at what time? Exactly. Perfect. Yeah. So you do the 7 to 10, you say, hey, 7 years from now, we think the 3 year treasury will be this. So all those combinations you have, there's more than this. I know it says 1 year, 2 year, 3, 5, 7, but you can get actually, in fact, when I was where you are, we got every single treasury ever issued was published in the Wall Street Journal every week or every day. You could go back, you can go find interest rates for every single year. I've had a tough time. I found a website that actually shows all the treasury yields, but I don't remember where I found it. So you can find a 6 year, you can find a 5.5 year, all of these. Now, what Bloomberg does is it takes this yield curve here and it produces every forward interest rate that's possible to produce off of this yield curve, and that's what it brings up in its table. So you have some blank spots because I can't tell you what the 2 year rate will be in 7 years, something like that. You know, there's no combination. I can tell you what the 5 year rate will be in 2 years, right? 2 versus 7. But there's a limit because we don't have everyone on the yield curve, but you actually can do a lot more interest rate forecasts if you do the entire treasury yield curve and all of it, including not just the ones shown on here. All right, so powerful stuff. That is the exam question, but on Monday we'll actually work a different exam question. Now your paper is due May 2nd, right? Which is the week after next. So, no, it's due next week. Is that right? So I might give you a little more time. So what I want to do on the 30th is make it an optional class day, but if you want to come in, what we're going to do, I forget when is our last class? Let me find that. The 7th. So in our last class, I was even on there. I want to talk about your paper twos. So next Wednesday, what I want to do is come in with your drafts. We won't spend the whole time here, or if your team wants to meet separately, remember your paper is individual, but I want your team to discuss the paper. It doesn't have to be a formal presentation, but you should at least talk to each other enough so you know who's going to talk about what. Think about organizing it. So we can do that next Wednesday. It's optional. I'll be here. I'll leave early, but I'll be here to discuss it. You need some help with it. If no one shows up, then I'll bring a jump rope or something. And so, but next Wednesday, not an official class next week, but I'll be here to help you with your papers. And we'll probably talk investing. We'll finish up accounting, talk about investing, and do another of the forward curve problems on Monday. So any questions on Wednesday? So it doesn't have to be a PowerPoint. You can actually just talk from your papers. We just need to organize it so not everybody's. And last year, one guy just went on forever and ever and ever. It's like, okay, so we've got to keep it short. We don't have enough time to have everybody talk for 20 minutes. So, all right, I'll stop it there and I'll see y'all on Monday.